Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you a setup that we did today at PowerCycle Trading for a long trade, but then immediately hedged it. So I always tell my clients and members that, if you're not able to hedge, you don't understand how to neutralize your risk, manage your risk, and hedge, then you're pretty much a trading accident waiting to happen. So we've been following Adobe here for a while, and you can see that Adobe's had this, had a big pullback, came back out above the 382 retracement. We had some nice moving average crosses here, back above the 50% retracement, and then we had this spike up where we got into the 618 and broke through it, and then came back down today, right towards the close. So it looked like it's trying to push and press through this 618, which gives it then kind of opens up the window for a move back up to those prior highs. So I like the pattern here. We've got a volatility squeeze on the daily, so if this triggers, we can get some good momentum to the upside. But the risk is, in this market, there's a lot of uncertainty, so the risk is this could pull back and fill this gap down here back to 320. So we set up a call debit spread to begin with, and then it started to falter, so immediately hedged it, and then we can hedge it some more. So let me take you through the hedging strategy that we used on this Adobe trade. So we went long the Adobe, that call debit spread here, and it looked really good. It looked like it was about to break above this opening range high, and then we started getting moving average crosses, and our momentum indicator started going negative here. So we immediately hedged it rather than risk the downside movement back down to that gap fill. So here's what we did. So the original trade was buying the April 24 series. That's for next week's expiration, 340, 342.5 call debit spread $1.15. So max risk $1.15 or $115 per spread, potential profit $135. Now, if this was to come back here to fill this gap at 321, right here, this would be down about $50 per spread. So half the at risk would be down in the whole $50. But by what we did was we sold the 362.5 bear call credit spread against it, and this is brought in $33 credit, reduces the at risk amount of $1.15 down, plus gives us less theta decay. And you can see now, if we were to move down to 321, this would be down only $22. Now the other thing we can do, and this is what we call a long call condor. So next week we've got now a total risk of 82. If it goes out between the short strikes, we can make 168. So really nice 2-to-1 return on that. And the other thing we can do, if we want, if this thing starts to pull down, we could sell another, we could sell the 342.5, 345, and we could turn this into a credit. So we could look to no downside risk, and we'd have actually $15 credit. Now that could be different tomorrow, but that's the other thing we could do. And then we've got defined risk of only $15 all the way up here to about 360. If it was to go out inside this zone here, we could make over 240. So a lot of things you can do if you understand hedging and how to take advantage of options to hedge. So if you'd like to learn more about this, I'll be doing a free workshop on option selling strategies this Saturday, April the 18th. So sign up and hope to see you there.